If you are a rescue worker or first responder, your pension is more than just a paycheck. It's the lifeline for your future. But are you aware of how it works? Are you aware of how to maximize it? Sadly, many aren't. Today, we're going to uncover some crucial details that you need to secure your retirement. Stay tuned. Today is an episode you won't want to miss. Welcome to Retirement for Rescue, the podcast dedicated to helping our nation's heroes, firefighters, police officers, military and medical workers secure the retirement they deserve. I'm Kurt Arnold, your host and financial advocate. Every week, we'll tackle the ins and outs of retirement planning, tax strategies, and benefit optimization. You spent your life protecting others. Now it's time to protect your future. Well, thanks for joining me for the first episode of Retirement for Rescue Weekly. This is a passion project of mine. I'm a financial planner. I'm a financial educator. I'm a speaker on different financial topics. And actually, I grew up in a firehouse. So my dad was a firefighter for over 25 years. We were living the life of, going out to restaurants, and then his pager would go off and he would leave and go run to rescue whatever it was at that time. So very, very passionate about the first responders, rescue workers, and want to give back and help teach so that you guys can understand more things that are related to your retirement that can be of help for you. Now, before we started this, we actually did some research. I talked to clients. I talked to people in the medical industry and first responding industry and asked, what are some things that you want to learn about that you're not really sure about? And we got a pretty good list of things that the people had given us as feedback. And so today we're going to start with pension, that pesky pension. That's there, it's accumulating, but you don't really know how it works and how to start it and when. So we're going to go over that today so we can help you maximize your pension. Now, with your pension, obviously, we're talking about the Florida Retirement System pension, and we want to help you make sure you maximize everything that you're entitled to. Now, this is a pension that's available to state and local government employees, including those frontline rescue workers. So this usually is a big part of each person's retirement plan as far as income goes. Now, before I jump to the content, I also want to let you guys know at the very end of this, we're going to have an offer if you would like to get started on learning more about these 10 pitfalls that people have given us as feedback. We will have that as a resource that you can download if you want to get started on kind of learning more and don't want to wait till next week. We have that resource for you as well. Now, we're going to go over about 6 or so concerns that came up when it came to the pension, as far as what are some things that kind of gave you some concern and I didn't really understand how this part works. One of them, of course, is the complexity of benefit calculations. How do I know how much it's going to be? There's different options. How do I know? It seems complex, and that's where a lot of people felt like I need to learn more about that. Survivorship options, there's different types of options. We're going to go over that in a little bit. How do we understand which one's going to be the best for my family? It's not always the biggest benefit, and you'll understand why in a moment too. And then what impact does inflation and cost of living have on the pension? As we've seen recently, the cost for groceries, the cost for cars and homes has skyrocketed. And we really felt that recently. And so it's really important that when you get into retirement, you understand how this factors in with your monthly income needs. Vesting requirements. This is oftentimes a concern too, is like, how long do I have to work to be able to receive this and be entitled to this benefit? Drop. What is drop? How does it work? When does it make sense to do it? And then what are the tax implications if I actually do have a pension, or if I want to take it out of the pension? What are all those tax implications I have to be aware of when it comes to that? Now, when it comes to pensions, there's usually 2 types that get mentioned. There's the defined benefit plan, where basically it's just a calculation that's based on your years of service and salary. And there's also a defined contribution plan, which is going to be basically you're going to be making contributions, and then you're going to have to pick different investment lineups. Usually they're alphabet lettered investments, and that will help understand how it gets invested. And that's more like a 401k type of vehicle. Now, as far as the first option, we're going to look at how that calculation works, which is one of the biggest concerns people had, is how does that work? Now, the calculation, if you want to memorize it, is the annual benefit is actually equal to the years of service times the average final compensation, the AFC, times a benefit multiplier. Now, this is where it gets a little confusing if you go online and don't really have all the reference. So total number of years you've worked in the FRS pension plan, that's of course important. But if you are a frontline rescue worker, which is this audience today, so hopefully that is you, understand that it works a little bit different for you. So full benefits are possible at age 55 with 6 years of service or 25 years of special risk service. So obviously, if you're on the front lines, you're a little bit more taking a little bit more risk than others. So those timelines are going to be different for you. Now, the AFC, the average final compensation, that is going to be an average of your final years of compensation. Now, you're going to see July 1st, 2011 as a common date throughout this. That is kind of like the before and after type of date that you need to be aware of. So for employees with service time before July 1st of 2011, it's going to be the average of your 5 years of service. And for those with service beginning on or after July 1st of 2011, it's going to be an average of your 8 years of service, highest years of service that will be used in that calculation. Now, the benefit multiplier is another thing to be aware of too, because if you just looked at it for the regular pension, the regular class employees, that benefit multiplier is 1.6 or 1.68 for most. However, for special risk employees, which are frontline and rescue workers, that multiplier is 3% per year, so much, much higher. Now, when it comes to survivorship too, when you actually get your calculations, you'll see a bunch of numbers and you're probably like, well, which one do I pick and how do I know? And that's why it's really important to understand some of the financial planning part of it as far as which survivorship makes the most sense. Now, option number one, it's going to be the biggest, but that's only for your life only. So you'll get the biggest amount per month, but then if you pass away, the pension goes away. Option number two is a annuity, life annuity for 10 years certain. Very similar to option number one, slightly less. But what happens is if for some reason you pass away in year 7, those payments will continue to a beneficiary for another 3 years. Sometimes this is where you would use this if you don't have a spouse and maybe you want it to go to your child. That's where this would maybe come into play. Now, the most common options you're going to see are the joint survivor options, which are going to be 50%, 66.67%, or 100%. And that's a really, really important that you know how that part works, because we want to make sure that when we're doing financial planning, we're doing income planning, that we understand how much that is per month now, but then down the road, is that going to be enough to help my spouse if I pass away so that they're not in any financial hardship? Option number 4, this is kind of a unique situation too. So it's like the joint survivor options, but it says with a pop-up. If your survivor passes away before you do, then what happens is it reverts back to life only, which is the maximum amount. And that's where it can actually be a benefit in that situation. Now let's look at a scenario, because I'm a financial planner. I want to look at numbers, and let's just look at why it's so important to get your pension amounts understood before you start those benefits. So let's look at John and Joan, and this is a retirement scenario, and actually it's very realistic, very close to a client I work with. John has a pension. He actually elected to take the full amount. He just said, well, that's the most, that makes the most sense. Let's do that. Didn't really think about the implications of, down the road if he passed away, which we know, by the way, women live longer than men. My wife reminds me of that all the time. So just remember that we got to think about Joan down the road. So his pension is $60,000 a year. Social Security, $36,000 a year. Hers is $18,000. So John has $96,000 of income, and Joan has $18,000 of income. Collectively, they have $114,000. Doing pretty good. They also have some other investable assets as well. An IRA pre-tax, which is $300,000, and then savings, they have $100,000. So another $400,000 they can use to help supplement retirement goals. So doing pretty good. But let's look at what happens if something happens to John. And we know that's what happens. Life happens. Let's look and see what happens when something happens to John. So John passes away. Now, because he selected life only, his pension goes away, and Joan has nothing as far as pension now. Now, the way it works with Social Security is if one spouse passes away, the surviving spouse maintains the higher of the two Social Security benefits. So she would keep his Social Security, but will lose hers. So that 114,000 now is down to 36,000. And that's a 68% decline in income because John passed away. Now, would that be a concern for you? Absolutely. Now, yes, there's some other assets that we could start pulling from, but ideally, is that going to last a long time? No, that's where that could run out really quickly. And so this is something that we have to think about when we're making those decisions to make sure we make the right decision. Now, inflation and cost of living, we're not talking about Coca-Cola here. We're talking about cost of living adjustment. That's going to depend again on that date. So whatever years of service you had before July 1st, there is some cost of living adjustments on that. But anything that's after July 1st of 2011, there is no cost of living. So that's a very important thing to understand. When you're trying to build a retirement paycheck, you have to understand how this is going to go down the road. Now, we know that with inflation, typically it's going to be somewhere in the 2 to 3% range. However, it's much higher. But when you think about your Social Security, usually that grows at about 2.7, 2.8%. And then maybe your pension isn't growing at all. And now your money is not growing with the cost of living. And we don't want to get into a situation where now we're running out of funds because we didn't think about this part. Now, vesting requirements. We also want to make sure, when have we accrued enough years that we are fully vested so we can make sure that we don't retire too early or we miss out on some benefits. And so again, that July 1st, 2011 is going to be a key date. If you started before July 1st, 2011, you need 5 years to vest. If it was after July 1st of 2011, you need 8 years to fully vest. Now, the drop program, that's one I hear a lot about when I speak with people in the pension program. And I think there's a lot of confusion about why to go into drop. So it's available for people in the pension plan when they reach that retirement eligibility. It allows employees to retire and have their monthly benefits deposited into a drop account, but keep working for up to 60 months. And this account does earn interest. It's about 1.3%, so not a lot. And then the balance is paid out when that employee fully retires. So when it's a lump sum option, that is where you might have it come out like you're going to pay off a mortgage, you're going to help pay for college. Maybe you're going to use it to buy a retirement home, things like that. That's where that would come into play. Guaranteed income, that's where sometimes before you actually want to retire, if you're worried about maybe having, as part of that calculation, your income going down, and you don't want that to affect your calculation, that's where you might go into drop to avoid that calculation actually hurting your actual overall monthly benefit pension. Continued employment income, sometimes people will kind of double up where they can get that income and then keep working, and then allows them to pay down debt or do some other things while they're working. This actually was designed as an incentive to help people keep working. So there was a benefit to help them stay in the program. Now, structured financial plan, this is where I kind of come into play. I always want to make sure we understand we have to give our money a job. Sometimes money needs to be income that we can use for monthly needs. Sometimes it's for down the road money. We kind of talk a lot about it like it's a paycheck versus playcheck. Our paycheck, we got to make sure that's taken care of on a monthly basis. But then that extra money that we're not using, that might be our paycheck, or maybe it's down the road to replace some income loss if one of our spouses passes away as well. So we have to kind of understand where this money is going to come into play and how we're going to need it. And that will help us determine, do we drop or do we not? And then health insurance considerations. That's a big expense for people who are retiring. If you retire before 65, which is before Medicare, sometimes people go into drop so they can actually maintain those benefits that they're getting right now. And maybe that health insurance cost is way lower than it would be if they had Marketplace or something like that. Now, tax considerations, we have to understand there are some considerations when you start that pension plan. Now, if you live in the state of Florida, there is no state income tax, as well as a couple other states across the country. However, if you go and move to a different state, possibly you could have a state income tax then. So you have to be aware of that if you decide to relocate. Now, federal income tax, that's going to go into your normal federal income tax brackets. It will be counted as income. The more this gets higher, it could impact other things as well as when those RMDs start, when you have tax deferred money has to come out. That sometimes is what causes Social Security to get taxed more and sometimes causes Medicare to go up as well. So that's where, again, that financial plan is, giving our money a job is really, really important. Now, if we do a lump sum withdrawal, if you just take it out, that is still pre-tax money, and that is a fully taxable event. So we have to be aware of that. I actually had a person that came to meet with me a couple months ago that they were going to do that. They were going to take the money out and they were going to go buy a house in another state, and there was going to be their retirement home. And it was a great plan, except for they forgot about this part, the tax part. And if they took it out, it would have been a very taxable event, but it also would have caused a lot of Medicare issues because their Medicare premiums would have gone higher than too because of that. And then if we're going to do tax deferred rollovers, again, it's pre-tax. So if we go from pre-tax to pre-tax, we stay in that same part of the tax code. We can go from a pension into an IRA. That's still pre-tax yet. That is not a taxable event. However, those funds are going to be subject to RMDs, required minimum distributions, beginning at age 73 or 75 based on your date of birth. So we have to be aware of that. Now, really quick on the taxes, because taxes come into play with just about everything. We always want to make sure we're aware of where Uncle Sam is and what he's doing. 3 different parts of the tax code that you need to know about. Taxable, which is going to be individual joint accounts, real estate, things like that. This is going to be capital gains type thing. So, 0, 15, and 20%. That's where that would fall into play. Tax deferred. That's where that is mostly going to be taxed. The pension plan, when it's income on a monthly basis, it'll go into those normal, ordinary tax rates. But also, if you move some of that out as part of a drop program into an IRA, when those RMDs come out, or when you just take money out for whatever need it is, you have to understand that's going to be taxed at those tax rates. Also, one thing to know that both of these tax codes, so to speak, are subject to change and are being reviewed right now to possibly change in the near future. President Biden did look at increasing this for his tax plan. I'm not sure what would happen if Trump or Harris wins, but we need to be aware of that. And these are going to go up in 2026 when the Tax Cut and Job Act sunsets, which means it goes away. So we have to know that that money is going to get taxed more down the road. And then, of course, the tax-free, which is going to be like your Roth money or money that's already been taxed. Now, again, when we're talking about taxes, it's important to know your tax brackets. If you're married, filing jointly, or if you're single, these are your tax brackets. It's a progressive tax bracket, so each dollar is taxed at a certain level. As you add other income, though, like your pension, like RMDs, things like that, that is oftentimes where you will go up in tax brackets, and that's why it's important to understand how you get taxed. If they decide to increase these, which we said in 2026 is going to go up, we'll talk about that more in a future episode. But when it does go up, that's where a lot of times people with pensions, they don't have an income problem. They have an income problem because they have too much income, because they already have a pretty good pension. They both have Social Securities with them and their spouse. And then you add in those RMDs and things like that. And that's where this can get a little haywire, where you're going to pay more taxes than you really should. That's going to bring an end to our first episode of Retirement for Rescue. Thanks for joining us. Before we go, though, at the top of the program, we talked about that free resource. I don't want to stop the program without talking about it, so let's bring that up. Retirement for Rescue, we have that top 10 pension pitfalls for rescue workers and how to avoid them. That resource is going to go over some of the common things that are pitfalls for people on this particular pension program, just like yourself. Some things to think about and some ways to maybe avoid those pitfalls. You're going to see a link in the show notes below. So look below here. You'll see a link for that where you can go over to that page and download that resource. And then before we go, don't forget, again, next week, we're here live every Thursday at 11 a.m. On the East Coast, 8 a.m. on the West Coast. Next week, we're going to talk about a fun topic. Not fun for everybody, fun for me to teach, though. Tax mitigation strategies. That's where we're going to show ways for you to minimize Uncle Sam's impact on your retirement planning. It's be a fun one, a lot of education, and I'm sure we'll get a lot of questions as we go through this. So looking forward to this. And thanks for joining us for today. Thanks for all that you do and supporting our community.